repegs, you already have the discount and premium game, right? And the other question is, you have unknown risk with USDT, you have unknown risk with DAI, and also DAI is largely collateralized by USDC. And I mean, if you're going to redeem, where are you going to redeem from? So we ended up staying put. It wasn't an easy decision. It was a very, it was a big turmoil, kind of internally, like just sitting on the sidelines. But, it turned out to be the right decision. And yeah, go ahead.
No, so I was very similar to us. I mean, we're quite well diversified. We've kind of been that way for some time. If anything, previously we've kind of shied away from USDT and favored USDC in terms of stablecoin part of the portfolio. But yeah, that definitely I think that obviously that thought process definitely shifted over the weekend. But the same thing for us, the exposure that we didn't have to USDC, we decided to stick with. We looked at it, and I think as I said, I think when you saw it at 88 cents, I think it's a knee-jerk reaction. We understood the situation to be that even if these funds SVB were completely lost, I think we were talking more like maybe 6% of the asset. So yeah, we kind of came to the same conclusion as well, actually. Yeah.
Yeah, I mean, downside capped. I mean, I think a lot of people in crypto, if you're thinking like stablecoin is stablecoin, algorithmic stablecoin is everything is Tether, which is UST, which is USDC, right? So, but we were looking at once the notice was published, about the size of the reserves, what about 8.2% being held in SVB, your kind of max markdown is capped. So actually, unfortunately, we saw a lot of exits in liquidity from the IPOR pools, but there were a lot of whales that were playing this kind of maybe not very risky bet, but you saw over the weekend, Aave and compound utilization went to 100%, right? You have people paying like 100, 120% per annum to borrow USDT. But what were they doing? They could take USDT. They was getting like a 4 to 6 to 8% premium, flip it for USDC, and play this delta. Betting on the repeg by Monday, or at least a partial repeg, and that turned out to be an extremely intelligent play. So it was quite interesting to see how it was playing out. So maybe on that topic, maybe you guys can jump in and tell us what is Clearpool for those.
Can you hear me now? Is it clearer?
There's like a lot of background noise and like some echo.
Is this better? Can you hear me now?
Yeah, it's better.
It's better. Okay, cool. Yeah, well, fine from our side to record. If you guys want to go ahead, that's fine with us.
Okay, so yes, so please note then everyone that I'm trying to record this, so it might be recorded.
Yeah.
Okay. So
all right. Yeah. So Clearpool. Intro to Clearpool. So Clearpool is a DeFi protocol. It's a lending and borrowing protocol. In one way, it's kind of similar to some of the protocols you guys just mentioned, Compound and Aave. But the big difference is Clearpool is uncollateralized or unsecured. So so the difference is, as you connect to one of those protocols, you will see a marketplace for assets. On Clearpool, you see a marketplace for borrowers. So the big difference here is this this aspect of collateralization. Clearpool is completely uncollateralized, and therefore when you lend to one of those borrowers, you are taking the counterparty risk of that borrower. So the borrower is borrowing based on their credit worthiness, their credit profile, or their credit reputation, however you want to term that. So going back to the beginning, why did we build Clearpool? So we saw that there was a growing demand for unsecured liquidity in DeFi. There was a lot of institutional borrowers coming into this space a couple of years ago, and borrowing on Compound or Aave or similar protocols is a very inefficient use of capital for these larger institutional borrowers. So, if they want to borrow stablecoins, they have to over collateralize by, up to 200 or 300% in some cases to be able to borrow. And of course, this creates capital inefficiency issues for them. So we saw this growing demand. We wanted to introduce uncollateralized or unsecured borrowing into DeFi. But really, the only way that you can do that is to introduce this concept of counterparty risk. And so we wanted to build a product that not only solved that problem for the institutional borrowers, but really also gave lenders the ability to monitor and manage risk effectively. So this is something that was really important for us from the beginning. So we designed the product with that in mind. So the way Clearpool works is we have a bunch of institutional borrowers. Those guys have to go through a KYC onboarding process. Part of that process is obtaining a credit rating from a third party. We work with a project called Credora for that. Once they've gone through that process, they've obtained a credit rating, they're able then to launch a borrow pool on the Clearpool app. Now, once the pool is launched, anybody can become a lender to that pool, to that borrower. So these pools are single borrower pools, but anybody can connect and lend. When you lend to the pool, you receive CP tokens. So these are very similar to the C tokens in Compound, for example, or A tokens in Aave. So it represents the liquidity that you've provided to that pool. It accrues the interest rate for that pool, and it also represents the credit profile of the borrower of that pool. So we'll get into that a little bit later, because these are kind of the building blocks for further risk management products down the line. So we've touched a little bit already on one of the aspects of giving lenders the ability to manage risk purely by having single borrower pools. So lenders are able to select exactly which borrowers they want to face, and they can avoid those that they don't. And then the way that the interest rates work on Clearpool is that it's determined through utilization. So how much of the capital in the pool the borrower is currently utilizing will determine the interest rate. There's an interest rate curve essentially in the pool. And as the borrower draws down liquidity from the pool, this will determine the interest rate. Now, we developed a very unique interest rate curve, a very unique shape. It is based on a cosine function, and it effectively means that the lowest rate on the curve is found at 85% utilization. So just to give an example, if we have a pool that's opened and we've got a bunch of lenders and there's $10 million supplied to this pool, borrower would be incentivized to draw down 8.5 million because that's where they would find the lowest interest rate on the curve. Now, the idea behind this is that lenders always have that buffer of liquidity for withdrawal. So as a lender, you're never really locked in to the pool on Clearpool. You can withdraw your liquidity at any time from that buffer of liquidity that remains in the pool. Now, when you have withdrawals, that would increase utilization for the borrower, and that also then would increase the interest rate that they're paying. So two things can happen. Either the higher interest rate attracts new liquidity from new lenders looking to farm that additional yield, or the borrower can decide to repay liquidity into the pool to re-optimize the utilization and interest rate. The borrower can actually use that mechanism to either grow the pool or to decrease the size of the pool. So they can choose exactly where they want to be on the curve to either attract liquidity or repel liquidity. But one of the other features of this is, again, sort of on this risk management topic, is that as a lender, you get compensated when the liquidity risk increases. So let's say there are withdrawals, the utilization creeps up. The higher it gets, the higher the interest rate goes. So basically, as there is less chance of you being able to remove liquidity from the pool, you're getting compensated with much higher interest rates. The pools can only reach 99% utilization. This is the highest. So if we have a situation like we had during FTX, where everybody wants to remove their liquidity at the same time, it pushes the pool to 99% utilization. At that point in time, the smart contract allows the borrower 5 days to bring the utilization back below a threshold, which is currently set at 95%, to avoid a default. There is a process if a pool ever goes into default. We haven't had one yet. So I think, given the fact that we launched the protocol last March, and shortly after that, we sat through Terra Luna, all of the events that followed that, and then, of course, culminating with FTX later on in the year. Clearpool worked incredibly well. Throughout most of the year, we continued to grow. We reached around about 200 million of TVL at the height. During this sort of major fallout event when FTX went bankrupt, all lenders on Clearpool were able to access their liquidity from all of the pools within hours or a few days at most of the bankruptcy announcement, with the exception of one pool where the borrower continued to repay and maintain the utilization below the threshold, which meant actually that the lenders to that pool were compensated with those higher rates. So it really worked well throughout all of that, which obviously we're very pleased to see. And I think those points that I mentioned on risk management. So we've got the single borrower pools, the interest rate mechanism, and the CP tokens are probably the sort of three areas that perhaps segue best into the conversation that is scheduled for today.
Hey, thanks, Rob, for this explanation. Just before we continue, maybe I would really like to bring you back a little bit to your interest rate module, because I think that this is something that is like very interesting for us as well, and for our community, like us building like interest rate index. So if I understand correct, what you're saying is like, okay, a pool starts from like 0% utilization to 100% utilization, and you say like between 0 and 80%, 85% utilization, the interest rate that the borrowers will be paying is slowly going to be decreasing, and it's going to be the lowest at 85%, And then if it starts increasing from 85%, it will have like an exponential increase for liquidity. Am I correct so far?
Yes, correct. So there is a spread between the rate that the borrower pays and that the lenders receive, and this is because the interest that is generated, regardless of the utilization of the pool, the interest that is generated each block is distributed to the entire pool. So there's naturally a spread between those two rates, but otherwise you're completely correct. That's right. So this is exactly why the borrower can utilize that mechanism, not just to grow the pool, but also to decrease the size of the pool as well. Correct? Yeah.
Yeah. So I think that the concept of utilization, like we are all very well familiar already. Like you do have a different curve than Aave, for example, and Compound. They just have a linear curve that starts from 0 and then becomes like more exponential after it reaches utilization. But like one of the problems that I really have with those credit markets is that basically they dictate, like they basically say, okay, at 80% utilization is our optimal utilization, and at 80% the interest of that token of, let's say, USDC is going to be, the interest that the borrowers are going to be paying is going to be 4%. And then once utilization goes above like 80%, it's going to start like exponentially going from like 4 to 7.5 to 11 and so on. So in a way, it's like they are kind of like setting kind of like a, how to say, like a soft ceiling for what the rate should be, because obviously like above 80% utilization, the rate starts increasing so drastically that it does not really make sense, because like somebody borrows like $5 million and suddenly everybody are paying like 40% borrow, yes, which kind of does not make sense, and it's not really how it works in normal markets. So, but really the problem here is that they kind of like are dictating what should the rate be, rather than have like some real dynamics for like, supply and demand. So when you set your interest rate, you say that at 85% the interest rate the borrowers are paying is the lowest. Yes, but like, how do you come out with the number that you're going to use at those 85%? So what exactly is, like, if I come right now and I want to borrow from some of the pools, if I'm an institution and so on, what determines what my interest is going to be when the utilization is 85%? How did you come with that number?
So for the 85% utilization point, this was based on some modeling that we did early on, and of course, at that point in time, we didn't know exactly how many lenders we would have in each pool, and and what would be the average deposit size and the size of the pool and so on. We tried to model that as best as we could, based on what we saw on other protocols, but at the time, most of the DeFi protocols that were out there were, over collateralized. So it was actually very difficult to try to model that. But 85% was the outcome. And it worked out very well. Ultimately, the idea behind that is to ensure that that you have adequate buffer of liquidity for lenders to withdraw whenever they want.
I understand for the utilization, but I was asking like the interest rate, the actual interest rate.
Okay, right. Yeah. So the interest rates are set actually through a decentralized mechanism. So we have what we call Clearpool oracles, and these are a bunch of institutions who are using Clearpool, or are institutions that are active in DeFi lending and borrowing markets. And what they do is they vote on where they think the interest rates should be, and this vote takes place every 2 weeks. Now, there are three parameters that give the curve its shape. So the rate at zero utilization, the rate at 100%, and then there's the rate at 85. So these are the three parameters that we ask them to provide every 2 weeks. And what that gives us is a distribution for each of those three parameters, which we then truncate and then take the sort of the average of the remaining range to set the parameters for the following 2-week epoch. So effectively, the curve reprices every 2 weeks through this process. And the way that we secure that.
Right now, for example, just so we can get the idea, yes. Right now, for example, what is currently the rate that borrowers are paying at 85% utilization?
It's 10.8%. 10.8. Yeah.
That's quite similar with other protocols that I have seen actually with uncollateralized lending.
Mm-hmm. Yeah. So anybody can see this. So if you go into our permissionless app, you can click on. There's only 2 active pools right now, but you can click on either of those 2 pools, and you can actually see the curve, and there's a bar which you can slide to any point along the curve to see what the interest rate would be. So yeah, at 85% is currently at 10.8%. So it's set through this decentralized process. The idea is that obviously the curve, prices with the movement of the market. So it's reflective of current market conditions. But it also ties in with our staking mechanism. So the way that we secure this is that those oracles have to be staking a certain amount of C-pool. By doing so, they create their own oracle pool. And then anybody else with C-pool can then stake to an oracle pool, so they can see where the oracles are pricing the curve. And you can effectively vote with your stake as to which oracle you think is pricing correctly. So this disincentivizes or discourages oracles from trying to skew rates one direction or the other. And this is kind of how we kind of secure that pricing mechanism, and it also gives some utility through that staking of the token as well.
So when we're talking about like collateralized lending, which is obviously the most famous form right now that we have in DeFi, and like uncollateralized lending, like when you compare those 2 rates, like you as an insider, because you have obviously like spent quite a lot of time of developing that curve. I saw the curve. I just played around with it. Yes, I see how the borrowers basically start right now at something like 14%. It slowly goes down to something like 10.8%. That's 85% utilization, and then goes up to like 24% at 100% utilization. So like maybe a little bit more of an insight of like when we're thinking about like uncollateralized lending in DeFi, like what are the guiding factors that basically create the pricing there? Yes, like if we need to somehow try to estimate, what would the fair price for uncollateralized lending be in the markets? Like what would we take as markers?
Yeah, it's an interesting question because now this process is purely in the hands of the oracles. So I guess that they're kind of better placed to answer the question. But I think ultimately this lowest rate has to be kind of where the supply and the demand crosses, right? So what are lenders, what sort of rates are lenders comfortable receiving for taking on this counterparty risk, and is there still demand at those rates from borrowers? Now, one thing that you can look at is that each of the borrowers have a credit rating, and right now we have these two pools that are left remaining from previously we had, I think, 10 or 12 pools open, but they each of the borrowers may have a different credit rating. So currently we have one C-rated borrower and one A-rated borrower, so they have the same curve. So the idea here is that the lower rated borrower, if they want to attract more liquidity, they will have to go slightly higher than 85%. That way they're paying a higher interest rate and they can attract more liquidity. So even though both borrowers have the exact same curve, but they're different, they have different ratings, they can still utilize that mechanism to attract more liquidity. So we've seen that play out. We saw some of the lower rated borrowers previously maintaining slightly higher utilization, and therefore I think I'm going back sort of pre-FTX, probably around September, October last year. I think the average interest rate was probably something around, back then, I think around about sort of 8.5%, 9%. But some of the pools were kind of paying more like 10 to 12%, because the borrowers were maintaining slightly higher utilization in order to attract more liquidity. So I think that's the way I would look at it. But what we are looking to do actually at some point this year is introduce credit spreads. So we will actually introduce different curves for different rated borrowers, which would also, I think, make the pools a little bit more efficient.
All right, thanks. That was my questions, because I really am the most interested in those like interest rate modules that protocols are doing. Obviously, the previous example was Euler Finance, when they were thinking of creating those like reactive rates. Sadly, they got exploited 2 days ago or yesterday. I don't remember already. But so we did not see that, but hopefully they'll continue, and then we'll get to see some like more innovation on those interest rate modules, because this for me right now is really the most inefficient part that we have in DeFi. So like you say that there are like those like the different types of borrowers, yes, A rating, C rating, and so on. So right now, is there some specific difference between them, or you say that in the future you're going to create like different curves depending on their rating?
Yes, the borrowers go through this process of obtaining a credit rating through Credora. So this basically just involves them providing their financial statements and API keys for the exchanges that they're active on, and wallet addresses for DeFi wallet screening. All of this together allows Credora to provide a credit score for each of the borrowers. So based on that, what we'll have is we'll have kind of like a base curve. So if you're a AA ratings, the highest rating they give, you'll be on the base curve, and then there'll be a spread effectively. So every notch below AA, the curve will increase by the spread, and this will be something that also will be priced by the oracles, so that the credit spread will be also something that the oracles will vote on. So once again, this is all being sort of priced through that decentralized mechanism.
All right. So in your opinion, what needs to happen in order for example, for retail to be more attracted to provide liquidity in such like uncollateralized protocols, as opposed to, you know, going to the normal, okay, I put my collateral, I can borrow against it, or I can just, you know, lend it for like 2 or 3%. Like, what do you want to see like being developed in DeFi, which is actually going to expand basically the scope of those uncollateralized markets?
So I think really just further product sophistication, you know, built on top of what we've already delivered. So, you know, as I mentioned earlier, throughout last year, there was a lot of volatility. But after each of those sort of like major market events, our TVL reached new highs. So what we observed, you know, throughout this is that we were attracting new lenders. You know, once the sort of the dust had settled following each of these events. So, for example, you know, after the sort of Three Arrows collapse, you know, as the market kind of dealt with that, we reached a new high, and then the same, you know, after Celsius, the same after, you know, the rest of the dominoes fell. So. So we kind of we felt like, you know, we were on the right track in terms of allowing lenders to withdraw liquidity at any point in time. This seems to be something that all lenders, regardless whether they're retail or institutional, find attractive about Clearpool. I think the problem is right now the entire market is very subdued, you know, on the back of FTX and now, you know, with the other events that have transpired recently, you know, we're just in this risk-off behavior period where the market is really not looking to take on much counterparty risk, which I think is completely understandable. So I think, you know, we have the product which is attractive to lenders in normal market times, and you know, we're confident that that lending activity will return, you know, once we get out of all of this. But beyond that, I would say, like, you know, just more product sophistication, and I think, you know, again, something that we're due to talk about today is perhaps composability, you know, with other DeFi protocols, so that lenders can manage their risk more effectively. So we're building, you know, other products on top of the what we've built already, which will allow lenders to do that. We've had integrations already with other protocols. Idle Finance is one which has they've built tranching on top of our pools. So you know, this is effectively a risk management tool for lenders, because they can then, you know, take you know, either more risk by going into the junior tranche and get an additional yield, or they can go into a senior tranche and have some first loss protection, but have a lower yield. So this is something that's already been built on top of Clearpool by Idle Finance. We're looking.
This is something that I wanted to ask you about, right? So,
Sure.
have you thought about adjusting your deposit structure, for example? I guess you know, with the Idle integration, you have the junior and senior tranches. What about natively? Because I mean, for example, in the USDC crisis over the weekend, right? You know, I can't remember who was it, but they were talking about, well, actually your EVU is potentially zero, which is probably not the case in the USDC, for example, if you're early to exit. But if you're the last one to exit, you could be stuck holding the bag, right? So these kind of liquid credit markets, in the DeFi sense, it's really the first person out who's cutting the risk, and those who remain who can actually be stuck holding the bag. Whereas, for example, in you know, the traditional banking case, there's clawbacks, there's legal protection. So have you thought about changing the deposit structure at all?
We have something similar. You know, if there is a default on Clearpool, there is a very unique default process, you know, which is backed by a suite of legal documents. which we can go through if you like. One other thing I think on this point is introducing a secondary market for CP tokens. If we take an example, let's say a pool borrower has been maintaining a very high utilization. Perhaps they every 5 days that if the pool is at 99% utilization, as I explained earlier, they got 5 days to repay. If they continue to do that, you have this situation where it's basically first come first serve, every 5 days to withdraw liquidity. Now maybe in this situation, if you're a lender, you can then go to a secondary market and offer your tokens for sale on the secondary market. Perhaps you might find a bid. Now, I think in these early days of uncollateralized DeFi, that perhaps wouldn't be super liquid, but this is effectively how the credit market works in traditional finance. So you have this secondary market where you can offer or bid to get exposure to the borrower. So this is something that we're looking at. First, so all of these things have to kind of come in layers. So I think before we do that, we want to introduce what we're calling term pools. The concept behind term pools is that if you look at the pools at the moment, they're effectively like an open term structure for the borrower and the lenders, as we've talked about. Of course, there's always demand from the borrowers for term liquidity. So one of the products we're building here is term pools. So basically, as a borrower, you'll be able to create a sub pool, which will have a fixed maturity. So let's say 30 days. So you will, as a borrower, you can create this pool with a fixed size and a fixed maturity date, and then offer additional yield for the lenders to then come and lock their CP tokens into this pool for that 30-day period. If you do that, you'll receive.
How does the rate calculation work for that then?
For that, it will be purely down to the borrower to decide how much additional yield they want to offer on top of the lowest yield or the current yield of the pool. So this part will be down to the borrower to decide how much they want to offer in order to try to attract the term liquidity.
So you're basically doing a depositor survey for the interest rates on liquid, and then you're doing an offer-driven rate for the term survey. It's an interesting approach. Why do you choose that?
Well, I mean, so it's because again, you have you've got the pool, the dynamic interest rate mechanism, right, which the borrower can use, to either attract more liquidity into the pool or to decrease the size. So he has some control over the interest rate that they're paying anyway. And now we're giving them the ability to attract some term liquidity, but right now there's no term structure of interest rates in DeFi. It doesn't exist for certainly for uncollateralized lending.
I mean, this is a big issue, right? So this is why I was interested, right?
This is I think this is the first steps to creating one, right? I think if this becomes if we have a situation where we've got dozens of borrowers, if we standardize these pools, so we have let's say 7-day, 14-day, 30-day, 2 months and onwards. I guess in the early days, we're still going to be talking relatively short durations. But this is kind of like the early days of kind of creating this term structure of interest rate. So we can see what rates the borrowers would be able to attract term liquidity, and of course we've already talked about the different credit ratings for these borrowers. So you can start to build a term structure of interest rates through that process, which then eventually may give us enough information or data to perhaps then put this to also through the the Oracle mechanism potentially as well. But I think there's not enough data out there, right now for the oracles to be able to price that effectively. So it's really down to the borrower to sort of have a bit of price discovery here.
This is effectively one of the problems that the IPOR is attempting to solve, and also, I think the approaches are somewhat aligned. So first of all, the data for essentially the forward rate is absent, right? We just have our finger in the air. And, in a sense, the survey mechanism is an interesting finger in the air, and it should be, for example, a premium to the IPOR rate, which is currently from the over-collateralized, right? You guys have essentially a risk premium with the counterparty risk, and, they're not putting up assets. It's more of a credit rating approach. And then, you guys seeming to, go out like 7, 14, 30 days at a time, right? Which it's a sensible approach. We do have this kind of finger in the air mechanism. On the IPOR side, we're doing, fair value pricing through different models, and you're doing a very kind of market-driven approach.
Yeah, absolutely. And like I said, I think that's probably really the only way to do it in the beginning. Maybe once we've launched that and we have more data, perhaps we can come up with a more effective way. But maybe that maybe the market gives us that. It just depends, I guess. How many borrowers we have. And how many pools and how liquid they are, but that is that I think is one of the steps that we need to take before we can get to this point where we have a secondary market, and once you have that, once you have this term structure of interest rates, a secondary market, you can then really start to think about other structured products that you can build, with that information, with that data. I'm sure that's going to be, very useful to guys like yourselves, and also, on the secondary side, that's going to allow for the likes of credit derivatives, or potentially like a repo market, as well. So you can really start to sort of think about, other products down the line that can be introduced, that will provide that additional product sophistication, which will continue to attract, more and more lenders into this space.
Yeah, I was going to say, it sounds like you guys need both a data layer and a derivatives layer. So, this is why we're looking at, what are the complementary pieces to build out mature credit, a credit space in DeFi.
Yeah, I think that's what we talked about, right? On that call from decades ago. That's what we were talking about, right? And I think we both agreed back then that it was probably a little bit early. One of the things that we have to consider with these pools is that to be able to provide interest rate derivatives on these pools, you have to consider that the borrower does have the ability to set the rate through the utilization mechanism. So I guess that introduces a level of complexity. But one of the way that we're sort of looking to initially mitigate that is to also create diversified pools, or basically an index, right? So let's say we've got a number of different borrowers, and we can create an index, a weighted index, so an average interest rate, and we have a pool where you can provide liquidity, and that pool then distributes your liquidity amongst all of the pools based on the weighting of the index. So you receive that average rate, and then perhaps you could quite easily build like an index swap on top of that, so you can swap out of the floating rate into a fixed rate. So I think Darren, we probably discussed that back then. I think this year we'll deliver that product. So it would be interesting, I think, to pick up that conversation again and look at potential ways where the two protocols can be composable for something like that.
Yeah, for sure. And I guess we're talking about higher yields with DeFi composability. What kind of things do you guys have on the roadmap in terms of composability with Clearpool?
Well, so we're building these products that I've mentioned, and we've already had that integration with Idle, with the tranching. So I think we're really interested to see who's looking to build in this space, and I think that the two areas probably are interest rate derivatives and credit derivatives. We've definitely got a vision where we also build a credit derivative product into Clearpool, and this has been something that we've thought about from the very beginning. But as I mentioned earlier, I think we need to get those other layers of products first before you can actually build something like that. But I know that there are teams working on that stuff already in different ways to how we envisioned it. So that those two areas I think are really interesting. And the reason for that is because again we want to make sure that that lenders have the ability to manage risk effectively in this space. And I think the infrastructure, the technology should provide a much higher degree of sophistication, product sophistication, and ability to manage risk than what we see in the traditional world. So these are the things that I think we need to see in order to continue to attract new players into this space.
Okay, cool. Well, I think we're coming up on the hour. I don't know if you guys in the audience have any questions. Raise your hand or type it in the chat. I don't know if Dimi, you have any more questions?
No, not specifically. I quite like the model with that curvature there, and like giving the borrower basically the ability to you can if you need more money, basically, well, okay, if you borrow more, you're going to attract more people to deposit into your pools. So I quite like that borrowers have that control, of being able to get extra capital. And I think that the solution with the curvature is very good. It's really just about like whether people are like, especially on the lending side, yes, because on the borrower side it's quite straightforward, especially like for uncollateralized borrowing. There is always going to be a demand, because obviously you get free money, you get to do shit with it, yes. And DeFi, there is always a lot of opportunities to like you can borrow on 10% from Clearpool and you can make 50% on IPOR. So like obviously there are plenty of opportunities for that. I'm just thinking in terms of like the lens, whether the retail lenders are seeking for like products that are going to be yielding like 2, 3, 4, 5%, and like it sounds to me like here the lenders themselves also need to be like bigger players, yes, rather than retail participants. And we also see that on Aave and Compound as well, yes. Like it's not a lot of retail on those credit markets. Yes, it's really just mostly accounts with millions inside, because otherwise it doesn't even make sense. Like if you want to put like $10, $20, $30,000 for lending, the interest that you're going to be getting on that money. Like it's hardly going to pay, you know, the transaction fees on Ethereum for this. So I'm thinking, how can we productize this for retail that really makes it like much more sexy?
Yeah, I think probably agree with a lot of that. I mean, we did see way more smaller depositors in our Polygon pool. So Clearpool is on Ethereum and Polygon. Most of the borrowers, I think I think we had around 10 or 11 or so borrowers towards the end of last year. Most of them had a pool on both Ethereum and Polygon. Whilst the pool sizes were kind of similar, so average pool size I know was something like $8 million. So the pool sizes were kind of similar on both chains, but obviously we saw a much higher number of lenders and a smaller average deposit size on Polygon as compared to Ethereum. So definitely the gas fees do play a part. And I think it's difficult for us to say exactly what was the split between institutional lenders and retail lenders, but I think for sure, we did see, and we know a lot of the institutional lenders that were active on Clearpool. So we know that that is where the market is right now. I think for retail to get involved, I think it needs to be simplified as much as possible. I think Clearpool is very easy to use. I think if you go and have a look, it's pretty self-explanatory and very user-friendly. It's very lender-friendly as well, as we've already explained. But I think things like the diversified pool. So we talked about being able to provide liquidity to a single pool, getting exposure to all of the different borrowers, and getting that sort of blended rate. Perhaps is a product that would be more suited to retail. But again, it's these pools are compounding, so auto compounding. So you can kind of lend, and you don't have to sort of do any sort of withdrawing of interest and redeploying. It's all done for you, so it's relatively straightforward. But I think that is something that is important for retail. Just as a final point, I know we're coming up on time. There's no questions. We're also building a new product called Clearpool Prime. It's actually going to be launching very soon. This is purely for institutions. So everything that we've talked about up to now has been the permissionless pools where anybody can connect and be a lender. We actually saw a lot of demand last year. We launched a pool with Jane Street as the borrower, which is kind of a more sort of traditional financial institution. We got a lot of demand on the back of that. This was what we called at the time a permissioned pool. So this is where the borrower and the lender both gone through a KYC process. So that seemed to be very popular. There's a lot of demand for this. There's a lot of institutional borrowers out there that that do have appetite to borrow through DeFi rails, but they need to know who the lenders are. They need to have KYC with the lenders and so on. So Clearpool Prime basically is built for that type of user, and this will allow borrowers to create fixed term, fixed rate, and fixed size pools, and select who they want to face from all of the other permission participants. So that is something that we've seen demand for on the institutional side. So it's a KYB AML compliant product, which is launching soon. And I think once again it still will give the ability for us to work perhaps with other protocols like yourselves in order to provide more tools for lenders in that environment as well.
Okay,
All right,
cool.
thank you.
Sounds like you got a lot of stuff going on under the hood. And I think Maria just shared an invitation to join the Discord invite contest. You guys want to say something about that?
Yeah, we actually launched the contest today, and we made it very simple. We didn't want to repeat all those stories with, like never-ending list of tasks that you need to complete to participate. So the task is very simple, and it is about simply the invites. It's gonna last throughout March until the end of March. Started today, so like everyone is definitely welcome to join. And thanks very much that we had this opportunity to also invite your community to participate. We appreciate.
Right, cool. Thanks, guys, for coming. Look forward to doing the Twitter space soon with you guys. Yeah.
Yeah, we look forward to hosting you this time on our channel. So we haven't actually fixed the date yet, but it's gonna happen in a couple of weeks. So we invite everyone to join. We will be announcing it on our channels and obviously here in your community as well. So yeah, we definitely appreciate that we could get to know you, your community, and thanks for having us.
All right. Thanks a lot, guys.
Thanks, guys. Speak soon. Cheers.
Yeah.
Cheers.
Thank you guys. Bye bye.